The earlier you begin investing, the more time your money has to grow through the power of compounding. Many people delay investing because they believe they need a large amount of money to start, but this is a misconception. Even small, consistent investments can grow significantly over time. The key factor that makes the biggest difference in wealth accumulation is time, not the amount of money initially invested. Compounding works by generating returns on both the initial investment and any previously earned returns. Over time, this creates exponential growth. The longer money is allowed to compound, the greater its potential to grow. This is why someone who starts investing at a young age, even with small contributions, can end up with far more wealth than someone who starts later but invests larger amounts. One of the greatest advantages of starting early is that it allows an investor to recover from market downturns. The financial markets go through cycles of ups and downs, but history has shown that over the long term, markets tend to grow. Investors who start young have time to ride out market volatility without needing to withdraw funds. They can afford to take a long-term approach, allowing investments to recover from temporary declines and benefit from future growth. Many people hesitate to start investing because they feel they need to learn more before making any moves. While education is important, waiting for perfect knowledge is a mistake. No investor knows everything, and the best way to learn is through experience. Starting small and gradually building knowledge over time is a more effective approach than waiting for complete understanding before taking action. Financial education is a lifelong process, and those who invest early give themselves more time to learn and refine their strategies. Another advantage of starting early is the ability to take calculated risks. Younger investors can afford to invest in assets with higher growth potential, such as stocks or real estate, because they have time to recover from potential losses. As people approach retirement, their risk tolerance typically decreases because they have fewer years to recover from downturns. Starting early allows an investor to take advantage of higher risk, higher reward opportunities while still having time to adjust their portfolio as needed. Inflation is another important reason to start investing as soon as possible. The value of money decreases over time due to rising prices of goods and services. If money is kept in a low-interest savings account, it loses purchasing power every year. Investing in assets that grow at a rate higher than inflation is necessary to preserve and increase wealth. Those who delay investing often struggle to keep up with rising living costs, while those who invest early benefit from inflation-beating returns. Another factor that makes early investing powerful is the ability to reinvest dividends and interest. Many investments, such as stocks and bonds, generate income in the form of dividends or interest payments. When these earnings are reinvested, they contribute to the compounding effect, accelerating wealth growth. The longer the reinvestment process continues, the greater the benefits. Those who start early have decades to reinvest and compound their earnings, leading to significantly higher returns over time. Delaying investing often leads to missed opportunities. Market cycles create periods where asset prices are relatively low, presenting ideal buying opportunities. Those who wait for the perfect moment to start investing often miss these opportunities, while those who are already in the market benefit from long-term growth. The sooner an investor starts, the sooner they can take advantage of opportunities as they arise. Starting early also instills good financial habits. Investing requires budgeting, discipline, and long-term planning, skills that benefit all areas of life. Those who begin investing at a young age learn to prioritize financial growth, avoid unnecessary spending, and build a strong foundation for future financial success. These habits lead to greater financial security and independence in the long run. Investing consistently is one of the most powerful strategies for building long-term wealth. Many people believe that successful investing requires perfect timing, buying at the lowest point and selling at the highest. However, even the most experienced investors cannot consistently predict market movements. Instead of trying to time the market, a more effective approach is to invest regularly, regardless of market conditions. One of the most reliable ways to invest consistently is through a strategy known as dollar cost averaging. This involves investing a fixed amount of money at regular intervals, such as monthly or quarterly, regardless of whether the market is up or down. By doing this, an investor buys more shares when prices are low and fewer shares when prices are high, ultimately reducing the overall cost per share over time. This strategy eliminates the stress of trying to determine the best time to invest and ensures that money is consistently working in the market. Consistency in investing also helps remove emotional decision-making. The stock market experiences volatility, and investors who react emotionally often make poor decisions, selling in panic during market downturns and buying impulsively when prices are high. By sticking to a consistent investment plan, investors can avoid these common mistakes and stay focused on their long-term financial goals. Another key advantage of consistent investing is that it helps individuals develop a strong financial discipline. Setting aside money regularly for investments requires budgeting and financial planning, which encourages responsible money management. Instead of spending excess money on unnecessary expenses, investors who commit to consistent contributions develop a habit of prioritizing long-term financial growth. Investing consistently also takes advantage of compounding, one of the most powerful forces in wealth creation. When investments generate returns, those returns can be reinvested to generate even more returns. The longer money is left to compound, the greater the exponential growth. By investing regularly, an individual ensures that new money is constantly being added to their portfolio, further accelerating the compounding effect. A major challenge that prevents people from investing consistently is the belief that they need large sums of money to get started. However, consistent investing does not require significant capital. Many investment platforms allow people to invest small amounts, sometimes as little as a few dollars at a time. The key is to build a habit of investing regularly, no matter how small the contribution. Over time, even modest investments can grow into substantial wealth. Market conditions fluctuate, and some people hesitate to invest when economic uncertainty is high. They may fear a market downturn or believe that better opportunities will arise in the future. However, delaying investments due to fear or uncertainty often results in missed opportunities. The stock market has historically trended upward over the long term, and those who invest consistently benefit from overall market growth despite short-term fluctuations. Inflation is another reason why consistent investing is important. As the cost of living rises, money sitting in a savings account loses purchasing power. Investing regularly ensures that money is being put to work in assets that can grow at a rate higher than inflation. Those who invest consistently are more likely to preserve and increase their wealth over time, protecting themselves from the eroding effects of inflation. Another important benefit of consistent investing is that it provides financial stability and peace of mind. Instead of worrying about short-term market movements or trying to predict economic conditions, investors who follow a disciplined investment plan can focus on their long-term financial goals. They understand that markets go through cycles and that staying committed to regular investing will yield positive results over time. Building wealth through investing is not about making one-time large investments, but about developing a steady and disciplined approach. The most successful investors are those who commit to investing consistently, regardless of market conditions or external uncertainties. By making investing a regular habit, individuals can steadily grow their wealth, take advantage of compounding, and achieve financial security. Fear and greed are two of the biggest obstacles to successful investing. They drive emotional decision-making, causing investors to buy at market highs when excitement is at its peak and sell at market lows when fear takes over. Controlling emotions is one of the most important skills an investor can develop. Without discipline, even the best investment strategy can fail due to impulsive decisions made in moments of uncertainty or excitement. When markets are soaring, greed tempts investors to chase after rising stocks, often ignoring fundamental valuations. The fear of missing out can lead to reckless decisions such as investing in speculative assets or overextending financial resources. This kind of behavior is common during market bubbles when asset prices become disconnected from reality. History has shown that those who give in to greed often suffer heavy losses when the bubble eventually bursts. The key to avoiding this mistake is maintaining a rational approach and focusing on long-term investment goals rather than short-term gains. On the other hand, fear can be just as damaging. When markets decline, panic sets in, and many investors rush to sell their holdings to avoid further losses. This reaction is often driven by short-term thinking and a lack of confidence in long-term market recovery. However, history has proven that markets tend to recover over time, and those who panic and sell during downturns often miss out on the rebound. Instead of reacting emotionally, investors must stay focused on their long-term strategy and avoid making decisions based on temporary market conditions. One of the best ways to control emotions in investing is to develop a clear investment plan. A well-defined plan outlines financial goals, risk tolerance, and asset allocation. Having a plan in place helps investors stay disciplined during market fluctuations, reducing the likelihood of making impulsive decisions. When emotions start to take over, referring to a solid investment strategy provides guidance and prevents costly mistakes. Another effective strategy to keep emotions in check is to avoid constantly checking investment performance. Many investors make the mistake of monitoring their portfolio daily, reacting to every small movement in the market. This constant focus on short-term fluctuations increases stress and the likelihood of making irrational decisions. Instead, long-term investors benefit from reviewing their portfolio periodically rather than obsessing over short-term price changes. Diversification is another key tool in managing emotions. By spreading investments across different asset classes, industries, and regions, investors reduce the impact of market volatility on their overall portfolio. A well-diversified portfolio provides stability, reducing the need to react emotionally to sudden changes in any single investment. When one asset class declines, others may perform well, balancing overall returns and helping investors stay confident in their strategy. Investing with a long-term perspective also helps in controlling emotions. Those who understand that markets go through cycles and that downturns are a natural part of investing are less likely to panic when prices drop. Instead of seeing declines as losses, successful investors view them as opportunities to buy quality investments at a discount. The ability to stay calm and make rational decisions during downturns is a key characteristic of successful investors. Having an emergency fund also plays a role in managing emotions. Many investors make poor decisions when they feel financially insecure. By keeping enough cash reserves for unexpected expenses, investors reduce the pressure to sell investments during tough times. Knowing that there is financial stability outside of investments allows for a more rational approach to market fluctuations. One of the best ways to develop emotional discipline is through experience. Every investor will face moments of fear and greed, but learning from past mistakes helps build resilience. Over time, those who remain disciplined and stick to their strategy become better at managing their emotions. Successful investing is not just about knowledge and analysis. It is also about maintaining the right mindset. Diversification is one of the most important principles in investing. It is a strategy used to manage risk by spreading investments across different assets, industries, and regions. Many investors make the mistake of concentrating their money in a single stock, sector, or asset class, believing that a single strong investment will provide significant returns. However, history has shown that markets can be unpredictable, and even the best performing assets can experience sudden declines. Diversification helps protect against such risks by ensuring that no single investment has the power to drastically impact an entire portfolio. One of the key reasons diversification is essential is that different asset classes perform differently under various market conditions. Stocks, bonds, real estate, commodities, and other investments each respond differently to economic events. When one asset class is experiencing a downturn, another might be performing well. By holding a mix of assets, investors reduce the likelihood of significant losses and create a more stable portfolio. Diversification also helps smooth out investment returns over time. Instead of experiencing extreme highs and lows, a well-diversified portfolio tends to grow steadily, even if certain investments decline in value. This stability makes it easier for investors to stay committed to their long-term financial goals without being swayed by short-term market fluctuations. Industry diversification is just as important as asset class diversification. Some investors focus too much on a particular industry, such as technology, healthcare, or energy, without realizing the risks involved. While one sector may be thriving today, economic conditions can change quickly, and an entire industry can face downturns due to regulatory changes, technological advancements, or economic slowdowns. By investing in multiple industries, investors reduce the risk associated with any single sector's performance. Geographical diversification is another essential component of a strong investment strategy. Many investors focus only on their home country's markets, but international investments can provide additional opportunities for growth. Different regions of the world have different economic cycles, and investing in international markets helps reduce the impact of local economic downturns. Exposure to global markets also allows investors to benefit from growth in emerging economies and industries that may not be as prominent in their home country. A well-diversified portfolio is not about owning as many investments as possible. It is about carefully selecting assets that complement each other. Some investors mistakenly believe that simply holding multiple stocks means they are diversified. But if all those stocks belong to the same industry or market, the risk remains high. True diversification involves choosing investments with different risk levels, economic drivers, and market behaviors. Another important aspect of diversification is rebalancing. Over time, some investments may perform better than others, causing an investor's portfolio to become unbalanced. For example, if stocks perform well while bonds remain stable, a portfolio might become too heavily weighted in stocks. Regularly reviewing and adjusting investments helps maintain the desired level of risk and ensures that diversification remains effective. Diversification also plays a key role in protecting against market volatility. Markets are unpredictable, and no one can accurately predict which investments will perform best in the future. A diversified portfolio helps investors avoid the risk of putting all their money into a single investment that may fail. Instead of relying on one asset to generate returns, a diversified approach spreads risk across multiple investments, increasing the likelihood of long-term success. One of the common challenges investors face is the temptation to chase high-performing assets. When a particular stock or industry is performing well, many investors rush to invest heavily in it, hoping for continued success. However, market trends can shift quickly, and assets that performed well in the past may not continue to do so in the future. A disciplined, diversified investment strategy prevents investors from making impulsive decisions based on short-term market movements. A well-diversified portfolio aligns with an investor's financial goals, risk tolerance, and time horizon. Younger investors with a longer investment horizon may choose to allocate more funds toward higher risk assets like stocks, while those approaching retirement may shift towards safer investments like bonds and income-generating assets. Proper diversification ensures that an investment strategy remains aligned with financial objectives while reducing unnecessary exposure to risk. Financial markets are constantly evolving, and successful investors understand the importance of continuous learning and adaptation. Many people assume that investing is a one-time decision where they simply choose assets and wait for their wealth to grow. However, markets are influenced by a wide range of factors, including economic trends, technological advancements, political events, and consumer behavior. Without staying informed and adjusting strategies accordingly, investors risk falling behind and making poor financial decisions. One of the key reasons to stay educated is that investment opportunities change over time. The companies, industries, and assets that performed well in the past may not be the best choices for the future. Technological innovations, regulatory changes, and global economic shifts constantly reshape the financial landscape. Investors who remain informed are better positioned to identify emerging opportunities and adjust their portfolios to take advantage of new trends. Understanding market cycles is another important aspect of staying educated. Markets go through periods of expansion and contraction, influenced by factors such as interest rates, inflation, and economic growth. Those who study these cycles can make more informed decisions about asset allocation and risk management. Investors who ignore market trends may find themselves holding investments that are no longer aligned with their financial goals. Learning about different investment strategies also helps investors refine their approach. There are various ways to grow wealth, including value investing, growth investing, dividend investing, and index investing. Each strategy has its advantages and risks, and understanding them allows investors to choose the approach that best fits their objectives. Successful investors do not rely on a single method, but continuously expand their knowledge to improve their decision-making. Risk management is another critical reason to stay educated. Many investors focus only on potential gains without fully understanding the risks involved. Knowledgeable investors recognize the importance of diversification, asset allocation, and hedging strategies to protect their portfolios from market downturns. Staying informed about risk factors allows investors to make adjustments and avoid unnecessary losses. Financial education also helps investors recognize and avoid common mistakes. Many people fall into traps such as chasing past performance, following market hype, or making emotional decisions based on short-term fluctuations. By continuously learning, investors develop the discipline to stay focused on long-term goals and avoid costly errors. Another important reason to stay informed is the impact of inflation on investments. Inflation erodes the purchasing power of money over time, making it essential to invest in assets that generate returns above the inflation rate. Investors who understand inflation trends can make better decisions about asset allocation, ensuring that their wealth continues to grow in real terms. Tax laws and investment regulations also change over time, affecting how investments are managed and taxed. Investors who stay updated on these changes can take advantage of tax investment strategies such as utilizing tax-advantaged accounts or optimizing capital gains and losses. Failing to stay informed about tax laws can result in unnecessary tax liabilities and reduced investment returns. Adapting to new financial tools and technologies is another reason why continuous learning is essential. Advancements in investment platforms, algorithmic trading, and financial analysis tools have transformed the way people invest. Those who embrace these innovations can gain a competitive advantage by improving efficiency, reducing costs, and making data-driven decisions. Investors who resist change and stick to outdated methods may miss out on valuable opportunities. One of the best ways to stay educated is by following reputable financial sources, reading books on investing, and learning from experienced investors. Attending seminars, listening to financial podcasts, and participating in investment forums also provide valuable insights. The more investors learn, the more confident they become in their decision-making. Experience is another important teacher. Every investor faces challenges, setbacks, and unexpected market movements. Those who take the time to analyze their past investment decisions, both successes and failures, gain valuable insights that improve their future strategies. Adaptability is a key trait of successful investors, allowing them to navigate changing market conditions with confidence.